system. The country of America is nothing but a big casino. You go to a casino, what do you get? You get funny money for your dollar bill. And then you go out and place a bunch of wagers throughout the casino. And then if you're lucky, you're able to come back and cash some of those funny chips in for what Federal Reserve dollars. Now, the 1099-A. The 1099-A form is a very simple little form. Basically, all you have to do is put down your bank, your trust bank accessing account, your Social Security, all caps. Put down the Social Security number. Now, if you're doing, you want to go down and buy an automobile, basically you get the automobile dealership's EIN number, you put that in there. You take the copy of his invoice, and basically you keep a copy of that. You submit that into the IRS with a 1096. You tell them to go and claim that with the 1040 form that they use, or however they have to use to collect their taxes that are owed to them. The payment has been made. Now they cannot contest this. If they contest it, basically, then you can turn around and file a 3949-A against them, because you have made payment. Now some of them may not understand this process, so there's an easier way about this. You turn around, you get the invoice from them. You turn around and you make the 1099-A out to you as the fiduciary, the executor over that trust. So you have your Social Security number at the top, or Social Security account, name, all capital. Then you have and he's the lender. Your bank's the lender. And then you put the lender's number in there. That's going to be the Social Security number. Then you come down and you have the borrower. That's going to be you. You're the borrower. You put your name in there. You'll have to have a Form 56 in place properly, and you never make a Form 56 out for anybody else. It's for you and you alone. Unless you want to give one to your wife and let her have access to your account, which you should. Okay? Because it's supposed to be a joint effort in a marriage. So, you turn around and you put yourself down as the borrower. You also put in the borrower's tax identification number, the Social Security number there too. So that you draw it out of the Social Security trust, it's now sitting out here in limbo, and then you have to turn around, file a 1040 form in, a very simple one, and you can file as many 1040s during the year as you want to. Look at the very top of the form. And then you only fill out line 1 through 6. You skip down to line 61. You fill out the amount for what is in line 2 of that 1099-A. In line 2 is the amount of the invoice, what you wanted to buy. The full amount, because you have not gotten the money yet. The same thing is going to be in line 4. And then you say, does the borrower need to pay this back? No. You're just doing an exchange of assets. So you're still having the same value, but it's just in a different form. but you file that 1040 form in with a negative 1040V. You send it in to where the 1040V says to send it, not where the 1040 form says to send that in. I've got it I'm trying to update the American Remedy file and learn the ABC files, and basically it will show you some of the differences between the address to where a 1040 goes and a 1040V goes. They basically go to the same place, but you look at the zip code, and basically it's going to get dropped in two different boxes. When you submit a 1040V with your 1040 form, it will be processed one hell of a lot faster. It even says that on the 1040V form. So you can turn around, you should get a faster response. I didn't see that right away, so I have not gotten my stuff back. I need to resubmit this into Fresno with my 1040 and submit a negative 1040V along with that to get that process through. Because I'm not going to sit around and wait 6 weeks for the corporate side of the IRS to process my damn form. I need to do the same thing with the 1041 forms that I submitted. I did not see that I was missing a payment form, sort of like the 1040V, but it is a 1040T. The 1040T is a form that makes the payment to the beneficiaries of the trust. I'm the only beneficiary on my trust, so I need to fill one out, send that in with the 1041 form. And then basically those things should come back in a timely manner, roughly in a normal 3-day banking process time frame. Now, the 1099A is also for abandoned property. We turn around, and when we have a checking account, we have written checks out of the checking account. And if we do not write closed checks on those checks when we write them, basically they go out as wagering monetary instruments. They're creating Federal Reserve dollars, and they're also writing bonds against our account. The money that's in the account is slipped into the back room in another off-the-wall account, and that's what we have to claim back. Because if we make the payment, if we close those checks, it will come directly out of the checking account as real money. But if we don't see that, and all wagering contracts are a 3-year contract. The proof is in the pudding. Court tickets are held on the books for 3 years. The monetary system in this country is controlled by M1, M2, and M3. There is no M4. That's the first year of the contract, the second year of the contract, and third year of the contract. A 3-year contract. At that point in time, all the Federal Reserve dollars that were created from that initial contract have to be removed from circulation. They basically do that at the banks on a monthly basis. Most of the banks are either under state chartered banking system or under federal charter banking system, but they're corporate charter banks. They're not the de jure bank chartering system. Here in the state of Iowa, if it was to be on the de jure side, there wouldn't be a stinking bank here in this state. because that was what was in the original Constitution for the state of Iowa. So the banks are only in here under the corporate charter or corporate constitution of the state. I can get fired up on this thing very easily because I've just seen how much stuff has gone on. I have been submitting stuff constantly for the last 2 weeks into the Treasury Inspector General, to the Comptroller. No, I didn't send anything to the Comptroller. Yeah, maybe I did send something to the Comptroller of Currency, to the Chief Counsel for the IRS, and to the Attorney General, to my state treasurer, to my state Attorney General, and to my state senator. All of those guys, if they do not support us when we are out with the truth, they are all facing impeachment. Because if they are basically not following the law of the taxes, when we submit 3949As and they turn around and are not going to support us in those to get the CID to do what they're supposed to do, then they are committing treason against America and against the people of America. And that is impeachment, plus a few other things that could go along with that. The people in this country want your remedy? It's right here. But get away from all those other damn gurus. Stop going from one rabbit hole to the other. Either stick with me or just totally get away from me. I don't want to have a damn thing to do with you. I'm shaking the sand off my sandals in that regards. Now, if these other gurus want to learn the truth, and that they have just been misguided, I will sit down and work with them. But I am a student of no one of these other gurus. I am doing all of this stuff in a completely different manner. It does not merge with what they're doing. Most of them are doing it from the corporation side. This is from the individual, the owner, the creditor, the shareholder side that I am working on. I'm trying to work for you in putting this out. I've tried to put some court documents up there on the site. Very simple, little court document. Right of relief, right of discussion, right of action. 3 rights that you have that you didn't know you had. And basically that all ties into the 1099 ABCs. Especially into the 1099B. And the 1099 OID. That was what they were supposed to be paying us, the debt that they owe us with. But we've never been given it. You go into court and basically say, where's my 1099B for being here? You've got to be paying me to be here. Don't the corporations, for all like Ford Motor Company and all these other people, basically pay for the hotel rooms and the meals and everything else when the shareholders come to a corporate meeting? They should. We should be getting our pay from our corporations that we're the owners of. was so close on some of this well over 2 years ago. Well, almost 3 years ago, when Tony Fisher King came out here on the 8th of December, 3 years ago, and I brought up, we need to do a 1099-A. But I didn't fully understand the whole gist of it when I was saying that. I turned around and I submitted something into the IRS that they didn't have 1099-A listed as an acquisition form on their one web page. 3 weeks later, they put it up on there. Sent me an email and said, okay, we got it up there. I sent another web page in, but I'm going to have to I got to look it over. I might have to make a few corrections to it because now I fully understand the rest of the situation now with the 1040D and the 1041T form to get the pay out of these guys in a timely manner. Not the 6 weeks that they sit around and basically play games with us. Okay, I hope I didn't confuse you too much. Basically sit down, get a chalkboard, or an easel board, or eraser board, something. Draw some of these things out in a block diagram. See how they flow. Look at the forms. See who is who on the forms. Find out who you are. If we were told to do this when we were growing up in grade school, I think that any adult out here, no matter who they are, should be able to take the time to sit down and learn these damn forms. But you have to open up your mind and stop believing everything you've been told. The whole public school system was taught to be a cheater because they used the same test year after year. All you had to do was go and talk to somebody in the class right before you and find out what the test was the year before. These teachers ain't that smart. And basically they ain't really teachers because they haven't lived life. How could somebody that has not lived life ever be a teacher? The teachers were supposed to be the elders in their latter years, after they had lived their life. They were supposed to be teaching the young, while the people in their middle years were basically out putting their knowledge and everything into full effect. Not just for manual labor, but for inventive labor. Creative, knowledge-based labor, enjoyment labor. Okay? So, I'm going to wrap this one up. I think I tried to cover everything that I needed to on the 1099 ADC OID and also touched on the 1040 form and the 1041. 1041 applies to those that have gone out and gotten their EIN for their living trust. Everyone should be setting up a living trust. But I want to reiterate again, everyone needs to have a Form 56 on file, whether it's for the 1040 or the 1041, on file, with you being the executor and the date that you became the executor of that, and make yourself the fiduciary and the sole fiduciary over that.
But I think most people don't have this mindset. government owns me. The government can think whatever they want to think. Another individual, I don't care if he got $1 trillion and he's sitting over somewhere in another country, he doesn't own me. So he can basically go to hell. And what is your opinion about that?
Well, it's one that you have to, you know, how they say in a lot of areas, know thyself and to thy own self be true. If you know yourself, you don't get caught up in all this, him-hawing and who did what and how it happened. But that birth certificate allows these people to hypothecate cash flow. In other words, you come in with $100 million on a platform that they use to create more funds with it. Well, for 40 weeks, you're getting $100 million. You get $100 million a week for 40 weeks. Now imagine that. That's $2 billion. Got that? That's why the first tip would become gold. Now imagine yourself. Now your birth certificate is worth a minimum of $2 billion right now at your age. It's worth $2 billion. Imagine if you had 20 people that could put their birth certificate into a platform. How much better this planet would be if those people was philanthropic and was able to help their fellow men and show them what to do. And you can see how the lights would go on in a lot of places and the technology would come out. Because they have technology now in the government. They got 5,000 patents that could extend our lives, that could do this, that could do this, stem cells, this, that, and the other. It's all available there, but they don't want to bring it out because they would infringe on these corporations that they already have in place. Okay? So that's the gist of it. But if you know you could do that, they could do that in a heartbeat. If you could do that with 30 or 40 people, look how our community would come up. You wouldn't have to use, stringing lines of utility poles. You can come out from the sun, solar. You can come out from magnetic. You can do a lot of things, but it's not in them to do that because they're comfortable where they are because they're eating and sleeping very well every day. They don't care about the people that's living on the street. In fact, they get a thrill out of seeing those people struggle. I don't know what's wrong with people, but that's the way people operate. That's my belief.
Well, it is kind of, I do kind of look at people when I decided, when I started looking at this real closely, I started, when I started looking at the markets and trading platforms and all these different things, I had to say to myself, all this whole thing is churning and operating off the back of slaves. Off the back of slaves. Because in a real world, you get paid on what you produce, your labor. You know what I'm saying? You would go out and you would do an honest day's worth of work, and you would do an honest exchange for that. With the introduction of interest and all these different things, the sheets are that you introduce. Now we have a world where people can basically hypothecate this currency, and this currency has to be backed by something, and being backed ultimately by people going out, getting jobs, and working and doing things. Am I correct?
Right. Yes, you're correct. And on top of that, the fact that they are working for nothing because since 1933, there has not been any currency because it's all IOUs. Those obligations that we're passing. If you rob somebody right now, all you be doing is practicing because those bucks that you're getting out of their pockets, they're not worth anything. Their value is 3-4 cents. The paper and the ink, that's all it's worth.
Someone would argue that I can still get goods and services with this particular fiat currency, so it does have some value. It does have an intrinsic value in it, in so much as, hey, I can take this up to the store, I can obtain me some food, I can go to a dealership and get possession of an automobile, I can make sure that water and electricity is still provided for my home, all these different things. So in that sense, I think it people have a mentally kind of reject the idea that this money doesn't have any worth based off of the fact that all the things that they can obtain with. You know what I'm saying?
It's an intrinsic value that it has in your mind that it's worth 100, it's worth, 200, it's worth 1,000. But in actuality, it doesn't have any value. I didn't say that. Congress said that in 31, 24. Title 18, Section 8, page 17. They said that. I didn't say that. They said it was an IOU. They said it was an obligation. If it's an IOU, I didn't get any value. And there is no value in a Federal Reserve note. In the 20s, a $1 bill was the equivalent to 1 ounce of gold. You could buy a suit. You could buy a pair of shoes. You could buy a dinner for you and your significant other, and you could probably have you a drink of your choice, all for $1. Now, switching the clock now, that same item now would cost you close to $1,000. So the value has changed because the inflation factor. Why it's inflated? Because you got interest here that's accruing on something that has no worth on its own. It has to be given some. It has to be given some worth, and it has to make it appear if it's working for you, but it's really not working. It's working against you because the more Federal Reserve notes you put out there, the more debt you got. It's just a matter of time before you're dealing with it. And all of a sudden now, they just erased $16 trillion off the debt that the United States owes. How did they do that overnight? How did you do that? How did you just take $16 trillion off the table? You can see there's a problem going on here. There's a problem with
I'm of the mindset that, that federal debt instruments, I'm right with you. That the value really comes from the mind, not Federal Reserve notes, not any type of debt obligation. It's the ideas that people generate. A truly wealthy person is an individual that is connected with the source of all creation and knows that is the source of his wealth comes from. An individual about money or different things like that is actually really a poor individual because true wealth is rooted in the source. And I think that they kind of understand that I don't think that all of them on their level are evil people. I wouldn't say all of them are. I would say that a vast majority of them probably at these upper levels do have some type of evil purpose. But I think all of them understand and recognize the natural law. And I think in their mind, they're saying, hey, we're not doing anything to you. You're doing it to yourself.
Right. Because you are. Because you're not planning for the time when it will not be here. So you don't save any silver. You don't save any of the gold coins. You just let it go by and you like this paper because that's the only thing you've understood. But the day they shut the paper down, what do you do next? What is your next move? That's what you have to answer.
It was real interesting. Somebody sent me a link, and I was actually watching a thing where Obama was going into Africa, and right now they're developing Africa. And it just struck my mind. I said, these people, wealthy people, truly powerful, wealthy people, do not deal in debt instruments. And I tell you, they deal with the resources of the planet. They deal with gold, silver, oil, platinum, uranium, cotton. And what's funny is in the Bible, a truly wealthy person had those commodities. You had sheep, you had cattle, you had wheat, you had these, and if you had a whole bunch of head of cattle, you were the richest man on the planet, or whatever. That's what made you well, or you had gold or something like that. You actually had something that was real. Today, people are, and I think that is a problem, that people are really think that these IOUs make you wealthy. It doesn't. It doesn't, because it can be changed at any time.
Well, Article 1, Section 10 of the U.S. Constitution said it better than I could ever say. Nothing but gold and silver coins shall be a payment of debt. And they haven't done that in such a while, people can't even remember. Okay?
Well, Franklin Delano Roosevelt stepped in and changed all that. But let's get back to the birth certificate. What are your feelings on people doing UCC filings, getting the birth certificate, sending it to the Treasury, writing a bond off of it, trying to discharge debt, using UCC assignment? What are your feelings on all that? How does all that play into the tax code? Because I know I was watching, I think Greg Gentry, I was listening to him, where he actually cited a code that allowed for people to make these deposits of these instruments into their PDA accounts, and right after he ran it, they reserved that.
All right, welcome everybody. Today we're talking about another important topic. This one is timely, certainly one of the busiest areas of advice giving in the financial services marketplace, given our baby boomer population turning the age of 65 at about 10,000 a day. And the most popular thing to do, of course, is rolling money over from 401ks or other kind of workplace accounts into IRAs. And so making sure that those accounts are properly coordinated with the retirement plans. Obviously, this has gotten a lot of attention from the regulators as well, going all the way back to the best interest contract regulations during the Obama administration, and now with the later Reg BI and PTE 2020-2 regulations really focuses in on that. That's a whole topic by itself, but it's one of the reasons why we need to be up to date and be aware of a lot of the issues that are involved in when somebody makes a rollover, whether they make a rollover, and more particularly how we coordinate that IRA account, assuming the person's in that, into the retirement plan overall. These tend to be the assets that people go to last because their other assets are taxable and these are tax deferred. It's not, however, a qualified transition account or a qualified inheritance account, right? It's a qualified retirement account. And so those are the things that we're looking at in this particular area, and looking at whether to make an IRA rollover in the first place or not, NUA and investment factors and the other factors that go into the area, but also the lifetime and death time distribution rules that are associated with these plans. Retirement, of course, is such a common, critical process for people to go through. And we all kind of know the idea of the three-legged stool, the idea that we got Social Security as one of the elements. If we've been putting into Social Security throughout our careers, our ability to get some money back out supported by the government, not intended to be a retirement plan by any stretch of the imagination, but just a supplemental income stream for retirees. Unfortunately, about 70% of retirees, 50% or greater of their income in retirement because they didn't do enough of the other pieces. Qualified retirement plans were put in place by Congress in order to help people to save for their retirements, in order to incent them to do it, because personal savings, the other element of that, again, is personal discipline, and people may or may not engage in that personal discipline as they're going along. So one of the common guidelines that people use, there's a million different ways to sort of do the analysis. The key thing I tell people is get a good advisor and talk to them on a regular basis, right? At least once a year, update your plan and where your plan is. But just having an idea of whether I'm even in a position where I can get the kind of income that I need, the 4% rule is one of the ways that is used to be able to do that, right? You take basically the annual income that I want in retirement, subtract off whatever I'm going to get from other sources like Social Security, divide that by 4%, and that should give me an idea of the funds needed. So if I needed $50,000 a year in retirement, I'm going to get about 20 from Social Security, divide that by 4, the 30 by 4, and that gives me $750,000, and that's the amount of lump sum money that I'd need in order to be able to produce that 4%, being a presumably high confidence, sustainable rate of return that I could take money out of there, adjusted for inflation each year, and be able to be successful in that process. So we've been so focused in the industry on the growth of assets over time. Certainly that was the case in my career as an advisor, helping people to put money away, make sure that they are ready for retirement. But now we have this baby boom generation, of which I'm on the tail end of, that is coming into the retirement age period. And so this utilization aspect of it, the change, the shift that's taken place from building things up in a qualified retirement plan to taking control of that in your retirement. A lot of firms sort of force their clients out of the retirement plans. They need to do something else. And some people just do it for the freedom and access of being able to have it in an IRA. So the thinking about all the budget items that come along with that and how they would address the area of retirement is very, very important. The first step of that, of course, is how to keep the assets in retirement. Do I roll over the qualified plan to an IRA in the first place, right? They don't have many of the limitations that are put in place by qualified retirement plans. I don't have to go through the human resources department anymore. I don't have to deal with the employer anymore. I'm not limited to the investments that the plan gives me. I can invest in virtually anything. There are some limitations, and that's important to discuss as well. So that's kind of standard advice in the areas to roll over to IRA. But there are considerations to think about in that vein that may influence that decision for some people. And so they are reasonable and important things for us to discuss. Also, self-directed nature of the IRA can lead to inappropriate or disqualifying investments. When people have self-directed IRAs in particular, sometimes they have no idea what rules they need to follow, and they engage in prohibited transactions and other kinds of things that can blow stuff up. So again, working with a good advisor, very, very important part of that process. So in pretty much in individual retirement account, right? It's an individual's account. It still has the same tax protections, although it's not ERISA protected in the way the qualified retirement plan was. And that's why some of the regulations get concerned about that and people being taken advantage of in their retirement decisions. Because, of course, if we fail that test, guess what? Now we're dependent on the government. The government doesn't want us dependent on them. So a couple of key considerations. Number one, you can't borrow from an IRA. My 401k plan, if my plan allows it, remember, we're always talking about what the law allows, not what this person's plan allows. Very, very important distinction in there. So the law allows you to be able to borrow from IRAs under certain, from qualified retirement plans under certain circumstances, under certain rules that are placed within the qualified retirement plan rules. Now, again, like Canada's plan doesn't allow us to borrow from our plan assets. But if your 401k plan does, and if you have an outstanding loan, that loan would become due and payable, right? Or it can't be rolled over into an IRA because you can't borrow from an IRA. So if borrowing is one of the features that a client wants to have with regard to their plan, if they have it in their current plan, they couldn't have it in an IRA, that might be an important consideration for them. You can't pledge the securities for anything else, right? You can't use them as collateral, for instance. You also can't own life insurance in an individual retirement arrangement. And this is an important distinction as well, because a lot of qualified plans use life insurance quite extensively as one of the tools inside of the plan. Can generate some tax-free income as well, but life insurance is quite a common type of investment, and it might be an existing investment, again, inside somebody's qualified plan. If that's an important consideration for people, that is something to think about. It's one of the ways that I've seen people in very aggressive ways, right? When you deal with the ultra high net worth client, their retirement plan is generally a smaller part of their overall net worth. For the average American, it's often the single largest asset that they have. But in the ultra high net worth world, because of the caps about how much you could put into qualified plans, it's sometimes smaller. So I've even seen people take their qualified retirement plan, permit the purchase of life insurance, take the lump sum, I'm just going to make up a simple number, $1 million that's in my 401k plan, and buy a single premium life insurance policy. We all know that a lot of that goes to the death benefit and goes to commission and other kinds of things. When you're having a single premium type of product, it would discount the value fairly significantly. If you look at the fair market value of the underlying asset the next day, it's certainly not $1 million. It would be substantially less than that. And then simply withdraw the money, right? So they're withdrawing the money so they can go ahead and pay taxes on it now and have it outside of all the rules and regulations and things that are out there. So again, life insurance can't be owned in an IRA, can be owned if if the plan permits it, inside of a qualified retirement plan. Collectibles are another thing that, generally speaking, IRAs cannot invest in. I had a lot of clients who invested in various kinds of hard assets, coins and jewels and those kinds of things. So there are a few exceptions in there with U.S. minted gold, silver, platinum types of coins, but as a rule, collectibles are not one of the things that they can have in there. So that's important to understand for the holder of the account to know what they can invest in and can't invest in, right? We want to be able to do kind of a side-by-side comparison and make sure people are okay there. And then, of course, the prohibited transaction rules still apply. So generally, prohibited transaction is any improper use of an IRA account by you, your beneficiary, or any other disqualified person. I saw, for instance, a situation when I was doing an audit of a trust company, and they had IRAs within the trust company, but a lot of them were self-directed. And so in one of the self-directed IRAs, there was a concentration of a closely held business. That seemed an interesting type of thing, perfectly allowable investment, certainly. But as we looked further into it, because anytime you see a red flag go up on something, realize what these guys had done. 3 or 4 of them had owned a business, sold the business, made a lot of money. The money was in their IRAs because some of their stock was inside of the IRAs. The business declined under their now missing management. The new management of the company didn't do as well as they were doing before. They certainly know how to run the company, and so they went in its distress and purchased the company back. But they used their IRA assets to do that, essentially hiring themselves as the management of the company. And so that's really the outside use of inside money. Those kinds of things are not allowed. So these are the kinds of issues people will run across, or they'll buy a vacation home, or they'll buy a retirement house or something like that using the assets inside of their IRA. You can invest in real estate, but it can't be personal use real estate, not just for current personal use, but not even for future personal use. And so it's just important to understand that the prohibited transaction rules do apply in that. You can't borrow from it, sell to it, receive from it, use it. And when people are directing their own investments, you might imagine they don't have an advisor helping them stay on the straight and narrow. Sometimes people may improperly use the account. And if we do have a prohibited transaction, it ceases to be an IRA on the first day in which the transaction occurred, which would make the entire amount taxable at that point, right? The IRA tax shell simply falls away, as it would with a qualified retirement plan if they were doing the same kind of thing. And you would have taxation on the account. And if they're under 59.5, you'd also have your 10% withdrawal penalty. We'll talk about some of the penalties that come in as well. This is pretty much an academic rule at this point, the 10-year forward averaging rule, because I think all those people are already in RMD at this point. The rule still does exist out there. If you take a lump sum distribution, let's say $1 million out of the account, is everything that I have in the account. Obviously, that would push me into the top tax brackets at $1 million worth of income. And so what do? They divide the number by 10. Million divided by 10 be 100,000. Multiply that by the tax rates that would apply at the time, and then multiply that amount of tax by 10. So it's as if you took it out over a 10-year period of time. Just makes it a little bit cheaper for the taxes because you can roll things into an IRA and take it out at whatever actual pace you want to. I've never run across a situation actually where somebody used 10-year forward averaging in my own career. Another one is the net unrealized appreciation rule. And this is one that I find that a lot of people are not aware of. It certainly doesn't apply to a broad span of people, but if you have employer securities in a qualified retirement plan, right? Qualified retirement plan is a plan created by the plan sponsor, right? The employer. And so if they are securities of that employer inside of the qualified retirement plan, they are employer securities. Obviously, an IRA can't have employer securities because it's not attached to an employer. So when you take the just standard operating procedure stuff that you see out there in financial magazines, I'm going to roll my qualified retirement plan over into the IRA, you lose the ability to do NUA. And NUA, for the right person, can be an extremely valuable tool. So again, let's just use the $1 million example. Let's say I've got $1 million in my IRA and just make all of it employer securities for practical purposes. So let's say that is the fair market value of the employer securities that are inside of my account. And let's say that my cost basis on that is $100,000. See, a lot of people don't even know they keep cost basis on assets inside of qualified retirement plans, but they do for these and many other reasons. So the upshot of NUA is if I pull that money out, I have to take a lump sum distribution in 1 year. So let's say I distribute the entire $1 million to me in that year. That would normally be $1 million worth of ordinary income, but it's not. In this case, it would be treated as $100,000 in ordinary income, and the other $900,000 would be treated as net unrealized appreciation. If I took in-kind distribution of the securities themselves, I get to maintain that cost basis, which I've now paid for as ordinary income, and so I've established my cost basis of $100,000, paid the taxes, basically the ordinary income taxes on that $100,000. That's the basis of my securities that are now worth $1 million. So I have $900,000 worth of baked in capital gains, right? That's the NUA, net unrealized appreciation. When I sell those securities, then I would pay that capital gain tax. So if I later sold it when it was worth $1.2 million, let's say, then I would simply take long-term capital gains tax on everything between $100,000 and $1.2 million. Obviously, that's a huge benefit. Long-term capital gains rates at about 20% versus ordinary income tax rates at about 37%, right? You're almost cutting in half the tax burden on that portion. So when things are substantially appreciated, I would say at least 50% or more as a rule of thumb before this might start looking like a good deal. Because again, you have to pay taxes now, not later on. So if you have a substantial basis in the account, that's all ordinary income tax at the time the distribution is made. Here's the one funny thing about NUA. Let's say that the stock, in fact, doesn't go up. It goes down. It goes down to $800,000, and I've reached my threshold of pain, and I decide to sell the security. I would still have $900,000 worth of gain. Right, the gain, the net unrealized appreciation, is established with that. In the same way, if I passed away and passed that on to my heirs, right, we're talking about the estate planning implications here, they do not get a step up in basis, right, because this is not regular assets. It's not just an outright capital asset of mine. It is an asset subject to NUA. NUA is a form of IRD, income in respect of a decedent, and so that tax basis would also follow through my death to my heirs. But it's a really interesting little rule for people who can take advantage of that, who have substantial amounts of substantially appreciated employer securities inside of their IRAs, inside of their qualified plans. That's another reason to consider an outright distribution rather than a rollover into an IRA. So there are certainly things that would hold you back from that. Outside of that, you need to look at cost factors and all those kinds of things. Some of the things they say in the regulations to do is to look at all relatively available alternatives, do a side-by-side cost analysis, and then you have to establish a rationale. Why is it in the best interest of the investor to do this, right? That's essentially the test that we need to make in the process of doing that, in addition to all the standard suitability stuff, right? Age and income and net worth and investment objectives and risk tolerance and investment experience, timeframes, liquidity needs, and all those kinds of things. So when we look at distributions from retirement plans, and by the way, anywhere along the way, please feel free to ask questions. I'll answer them on the fly. If I see them come up in the chat, we'll certainly have time at the end to ask questions as well. But if something pops to mind, please feel free to throw it in, and I'm happy to address it. Sometimes it's better in the context of the meeting itself. So obviously, distributions can be either during lifetime or at death. During lifetime, that is what Congress intends naturally for this. Again, it is a qualified retirement plan, not a qualified inheritance plan. And so whether it's in a qualified plan or in an IRA, generally speaking, the tax rules work the same way. Some of the exceptions are different for the penalty, but outside.
Hi, this is Bezel Bay, and today you'll be enjoying Wtdta Radio, where we'll be exploring the world of accounting, current expected credit loss provisions, estate planning, and tax planning, just to name a few. Don't forget, in the evening session, we'll be definitely going into civics and syntactical trust. So remember, if you listen long enough, you will definitely learn something. Peace and love, family. Peace and love.
Of that the tax rules are pretty much the same. There's two major ages that we look at. The first of those is age 59 and a half, right? Again, retirement plan. So they want you to be a certain age before you're considering taking that out. Essentially 60 years old, right? 59 and a half years old and beyond, they go, hey, you're in the retirement red zone, go for it, take out whatever you want, anytime you want, for any reason you want. Until then, however, there is a penalty for early distributions. It's not a qualified tax-deferred savings account, right? That's not the intention of it. So it's not just to use for whatever you want, whenever you want. And so the early withdrawal penalty would apply. There's a lot of exceptions to that. We'll look at those on the next page. But normal distributions are anything after age 59 and a half. Once you get to there, you can take out anything you want, anytime you want, for any reason that you want, and it's simply subject to ordinary income tax if it is a traditional account, right? Unless it's a Roth, something where you've prepaid the taxes on it, therefore it comes out income tax free. All traditional accounts is really what we're focusing on here from a tax perspective in the money flowing out of the accounts. But the back end, the age that is in place, and this is new from 2020 and beyond, used to be 70 and a half. But anybody who's turned age 72 from 2020 and beyond, they just moved it back a year and a half, right? It was 70 and a half, now it's 72, is the period where you start required minimum distributions, your RMD, as a lot of people call it. That is your required beginning date, age 72. Following that, Congress wants to make sure that you are taking out the appropriate amount of money. And there's a 50% penalty for the amount that you should have withdrawn that you did not. As a result of that, qualified retirement plan custodians will generally automatically make that distribution to the participants in the plan. A lot of IRA custodians do that as well. They're not obligated to do so. I'm not obligated to take out a pro rata share out of each of my IRAs. If I have multiple IRAs, I could take them all out of one if I wanted to. But I see a lot of them do that, and I think it's just to protect their clients from making a mistake, from not realizing that they need to pull out or how much they need to pull out and not doing that on time. It's a substantial penalty as you. So let's go back to the 10% early withdrawal rule and look at some of the exceptions to that. I tried to put it all in one chart to make it easy to look at, to be able to identify the different pieces out there on the IRA side and qualified retirement plan side. We can look at the rules all the way down to here. You'll see that they're the same all the way across, and then below that you'll see that the IRA allows a lot more different kinds of distribution. So questions asked: do you think the Senate bill will, to raise the age to 75 will pass? I wouldn't be surprised at all. Naturally, it makes up the makeup of Congress, makes a difference in terms of the support for that, but the general idea is, in tough economic times, and certainly we've been experiencing some of that, although we've also seen markets reach record levels in recent years. The concern is that a lot of people just don't have enough money to save for retirement. So if they move that back to age 75, that would give people more time to be able to accumulate. It's offset to a degree by the fact that if you're still working, you don't have to take money out of the plan unless you're a 5% owner of the company. So you can wait 75 if you're still working, meaning I haven't saved up enough to be able to go into that. Certainly age 72 is over the full retirement age for selecting Social Security as well. So people who are waiting the longest they can, right? 70 is generally the highest age that you're going to see in that. So a lot of those bills, I think the actual age, the hard part for Congress in doing that is it slows down the revenue receipt that they're going to have. Last time they changed it a year and a half. If they go to 75, that'd be a 3-year spread. But anytime they're talking about retirement plans, it's simply a delay of the time that's there. It's a compassionate message, I think, for most people. They just say, oh, we're giving you more time to save for your retirement and become less dependent on Congress. And so I don't think it's a hard thing to pass as long as it's attached to the right kind of bill. Of course, we never really pass things based on just those one issues. It's always whatever the bill is that it's tied to. So It wouldn't surprise me a bit to see that. Most things that are around retirement and are presumably pro-worker are very, very popular types of bills for the same reason that, unlike a lot of people, and I was as cynical about it as anybody else, I believe that Social Security will always be around in some form. It's just a difficult thing for politicians to vote against. They might slow things down. They might change certain things about it. They always talk about it going broke, but it's paid for by funding, right? Congress determines the funding based on taxation that they put into place. And so I don't think any politician wants to be the one who's responsible for seeing some kind of even supplemental program like that go away. And so again, that kind of goes back to that compassion element. If we took it down to pure mathematical rationale, I think it would be a different argument. But from a practical standpoint, I think it's just good political messaging. And sadly, that drives a lot of decisions that get made. So on the IRA side and qualified plan side, let's just go through quickly the rules you're probably quite familiar with. Number one, if you're over 59 and a half, there's no 10% penalty. Death and disability under the government's definition of that. So basically stiff, right? Any occupation, not own occupation disability. Periodic payments, this is the 72T. Some people use the code section regulation that basically says you can take substantially equal payments. So if I was working for a tech company and I'm a young 35-year-old programmer and my company takes off and I've got a lot of the stock in my retirement plan, I mean, I could retire at 35 and start taking substantially equal payments. Just divide my life expectancy into the balance in the account. That's the amount that I need to take out every year from that. Divorce degree. So qualified domestic relations order is one of the exceptions to the rule where somebody else can become an owner of the plan because it was my spouse. Naturally, the federal government looks out for themselves. And so a federal tax levy, not a state tax levy, but a federal tax levy can be taken out of your retirement plan without a 10% early withdrawal penalty. And adoption and birth expenses. So you'll see a number of things that are related to sort of health oriented plans, and we'll see a lot of those more on the IRA side, because if I'm still working, right, I have qualified plans, was put together by a plan sponsor, and so I have a job, my health plans at work should cover a lot of the kinds of things that you see down below. So one of the things that's for qualified plans, but not for IRAs, is over age 55. So 55 is kind of the early retirement age. If you're over 55 and separate from service, that's what it means by separated. It's not a marital thing, all right? And you separate from service, then you get to, you can take the money out without the 10% early withdrawal penalty. There's another question. What are the rules for RMD? So I'm going to go through those for you for 401ks and RIAs. If somebody, you mean IRAs, right? If somebody is still working at age 72, if they are working part-time, is there a weekly time cutoff? I don't know that off the top of my head. If somebody does, please put that in. They usually use like 19 hours as the distinction time, but I just saw some of those rules recently, and I wasn't thinking about that aspect of it, the time aspect of it. But if somebody knows the time period, how do you define working, right? Is there can I work an hour a week, mow my neighbor's lawn and call myself still working? So qualified plan, you can take it out over age 55. Obviously, since IRAs are not connected to a workplace, that is not a rule for them. And then the IRAs have a lot of the stuff that we would normally have in our workplace, right? So medical expenses, medical insurance, those kinds of things, which if you're in an individual retirement account, presumably you don't have in there. Also excess contributions that might be made. That's the case for either one of them, because if I've over contributed into the plan, some plans allow you to put more money into the plan. That certainly is not going to be subject to the 10% withdrawal penalty. That's usually after-tax contributions that are being made.
All right, family. Hope I'm coming in loud and clear. Let's think about this in the right perspective. I'm going to share with you my screen. All right, so let's see. Okay. Now, this manual is a manual for notaries. And it was published in the Bankers Magazine in New York, dating back 1853. Some of the contents deal with foreign laws regarding bills of exchanges and promissory notes. It also deals with prerequisites of bills of exchange, endorsements, presentments, presentations for acceptance, of acceptance, proceedings upon, and non-acceptance. Let's go to page 10. Just bear with me. Page 10. 7, 8, 9, 10. Dealing with foreign laws regarding bills of exchange. We shall give in the following pages a synopsis of the law on bill of exchange and promissory notes. As recognized in the United States and England, and the prefix, a general statement of law on this subject which prevails on the continent of Europe. Hold on for a second. Also, it deals with foreign laws regarding bills of exchange and promissory notes. As the English law agrees in almost every particular with that in the United States, we shall here point out only the principal and essential rules which prevails on the continent of Europe among the different nations in regards to bill of exchange and promissory notes. The most important nations are the French and German. The French Commercial Code on bills and notes have adopted into a number of other countries, via Belgium, Medina, Sardinia, Lucia, Poland, Greece, Geneva, Haiti, Ionian Islands, Turkey, and Wtdta, the Palapa States, Luxembourg, Tessin, and Wallis, with but slight variations here and there, so that when we speak of the French law, it will equally apply to all these countries. A new and uniform code of law regarding bills of exchange and promissory notes have been introduced since 1849 throughout Germany, with the exception of the small states of the Great Duchy of Luxembourg and the Duchy of Limburg and the principalities of Liechtenstein, so that when we speak of the German law, it will always apply, or it will apply, to everyone in the 38 states of Germany, except for the above named 3, including the whole of Austria and her crown lands, the whole of the Prussia, Württemberg, Bavaria, Hanover, Saxony, Brunswick, Baden, etc., containing more than 60 million people in the important commercial cities of Hamburg, Bremen, Frankfurt on the Main, Leipzig, Liechtenstein, Berlin, Vienna, Treaties, Brunswick, and Stargard, etc. There exists yet district codes on bills and notes in Russia, Holland, Copenhagen, Spain, Portugal, at Basile, and St. Gallen, which we shall notice where they essentially differ from other codes. The law on the continent of Europe in regards to the legal remedies on bills and notes is more stringent than in regards of other civil contracts, and as so far as it allows personal imprisonment. I'm going to repeat. Insofar as it allows personal imprisonment for a breach of such commercial engagement, be it as the drawer, acceptor, endorser, whereas no personal arrest and imprisonment can be had against the debtor for an ordinary debt. When we use the expressions that the party is liable according to the laws of bill of exchange, it must be understood and also to be mean that these extreme legal remedies are coercion and may be applied to him. Why did I read that? What if most of what you're dealing with are still governed under these rules of bills of exchange? And what if you're operating in a treaty that was alluded to during the Walker-Todd examination, what we call the Walker-Todd affidavit? What if, before they took out of circulation modern money mechanics, they alluded to the fact that fiat is nothing more than a faith game predicated upon the people's faith? These promissory notes is what's binding you to the crown and to the system. And they said, render to Caesar what is Caesar. Render to God what is God. Keep listening. Because if you listen long enough, you'll learn something.
ESOPs are, of course, a form of qualified retirement plan. So ESOP dividends are an exception naturally for the qualified plan, but not for IRAs. And then the other ones are all IRA-related exception. They want to make sure that you are medically taken care of. So adoption, birth expenses, medical insurance, even extend that out to funeral expenses. And you kind of see those are all related down the medical line. And then in addition to that, you've got making sure a roof is over your head. So making sure the person is able to buy, build, rebuild their first home. Think about the hurricane disaster we saw down in South Florida. For a lot of people, right, it wiped out their home. So the ability to be able to rebuild their home, prevent eviction, a natural disaster affecting your permanent residence, those kinds of things as well. And then also for education. Again, workplaces would presumably have special rules for that, but for an IRA and individual account, the more I further my education, presumably that allows me to get better jobs and better paying jobs or have more accessibility to a job, as well as reservist distributions. Again, workplaces would generally have in their benefits program special rules for that. IRAs wouldn't include that. And so those are also exceptions, that 10% rule. So just easy to compare and contrast in a simple chart around that area. Minimum required distributions from the plan begin, of course, on April 1st of the year after which the owner turns age 72. But I think we all know you probably don't want to wait that long, because if you wait that long, you'll have to take your second distribution in the same year, and that'll usually push up your income and withholdings the following year, etc. So generally speaking, taking that by December 31st still makes sense of the year in which you turn age 72. Depends always, of course, on the total makeup of the income that individual has, what else, sources of income that they have, what tax brackets they're in, etc. And then you go to the minimum distribution amount. And so the minimum distribution amount, once I get to age 72, is simply going to rely on the uniform table. The uniform table is the life expectancy of the owner of the account and one 10 years younger than that, right? It's just a hypothetical individual. They used to actually look at who the beneficiary was and make the cutoff based on that. And it was way, way, way too confusing. So basically, the uniform table is simply a hypothetical table of me and one other person 10 years younger than me, what our joint life expectancy is going to be. The only time you can use the actual life expectancy is if your one other is your spouse, and your spouse is in fact more than 10 years younger than you. Then you can use the spouse's actual life expectancy. And again, the penalty here is huge. So very, very important that we take that distribution out and take that distribution on time. You can also do qualifying charitable distributions. And I'm sorry, I need to change that in my materials. When everything went to 72, there's sort of the automatic assumption that everything went to 72, but they didn't change this rule. I believe it is still at 70 1/2 for a qualifying charitable distributions. Refer them by their initials, a QCD. These are for IRAs, and in an IRA, if I have a required minimum distribution made to me, I can have that directed straight to a charity instead. Naturally, you'd think that wouldn't matter. I have the IRA. I've got the charity that I want to give money to. And the presumption is this. If I take $1 out of the IRA and I give $1 to charity, I'm going to have $1 worth of ordinary income in one hand, and I'm going to get $1 of deduction in the other hand, and those two things will offset. But of course, that's not the case for a lot of our clients, especially if they're higher limits, and the P's limitations or things like that are in place that trim down the amount of deductibility that we get. This is some of the income tax rules the Biden administration has tried to promulgate and will continue to do so. Don't know if those will be successful or not, but we don't always get a dollar for dollar write-off on those deductions. And so what a QCD does is it distributes it straight to the charity. I never receive the dollar of income. I don't get the tax deduction. Effectively, it's wiping out dollar for dollar the money that's coming in to me. So people who are charitably inclined, giving money to charity, that is a great way to be able to take it if you don't need the money yourself, to be able to pass it through to a charity. It does have to be a public charity or a conduit private foundation, meaning whatever's coming in is going back out to charity. They don't allow it for donor advised funds or sporting organizations, which are also, of course, charitable organizations, public charitable organizations, but they don't have the required distribution standards. So they want to make sure that it's getting into the hands of a charity to be able to use currently, rather than into an account that could defer the payments over time, even though donor advised funds substantially, way over the private foundation rules, make distributions. But notice that private foundations are not allowed in there as well, only if they're conduit private foundations. So payment would otherwise be fully qualify for the charitable income tax deduction. So you can't have raffles or fundraising dinners. There's no quid pro quo coming the other direction. When you are doing these arrangements, it is a distribution to a charity. And then the distribution rules for the participant at death. And so there have been substantial changes in this area by the Secure Act, right? And we've been looking at those for a couple of years and kind of interpreting what was going on with those regulations. And so I want to spend some time in the rest of the session kind of looking at those distribution rules and the typical beneficiaries that people would have in their estate plan. So we're shifting from lifetime distributions to death time distributions inside of these arrangements. Basically, it breaks down into three key categories. Secure changed this. The IRS interpreted what that meant to us and now has come back and said that they were wrong on some of those points. So pay close attention here. If you haven't paid attention to the latest changes in this area, in February, I think of this year, they put out new proposed regulations wherein they disagreed with their own findings in the past with respect to distributions. I still don't find the new regulations completely clarifying in some of the counts, and I'll show you what that is, and I'll kind of give you my opinion about how some of those pieces work. But this is a very important area for us to continue to pay attention to because they changed the rules. So the default rule basically used to be 5 years, and they changed it to 10 years. And so the general thinking was that you could, if you wanted to, wait as long as possible. It's not always smart to, but just wait 10 years and take everything out by the anniversary, by the year in which the anniversary of death occurs, in the 10th year. So basically waiting 10 years after death and take the distribution out then. That, of course, again, would be a lump sum distribution. It's going to be at ordinary income tax rates. It's going to push you up perhaps in the highest tax brackets if you do that. And so spacing it out, working with a financial planner and making sure that we're thinking about how those distributions take place makes a lot of sense. So we distribute by 100% by December 31st of the year in which the 10th anniversary of death occurs. We'll just call that the 10-year rule. Obviously, if I die early in the year, it's almost 11 years. If I die late in the year, it's closer to 10 years. The distinction that they made in the regulations is when the IRS wrote this up, they said, we noticed that Congress didn't repeal the at least as rapidly rules, and I'll abbreviate that in the materials, ALAR, the at least as rapidly rules, which say basically that if you were over age 72 as the participant in the plan, it meant you were into your RMD phase. You were taking life expectancy distributions, which means even if you're dealing with this 10-year period, that the beneficiary would likewise have to continue taking lifetime distributions. At least as rapidly means the method, not the dollar amounts. So obviously if the person who's deceased was 80 years old, and I'm their child and beneficiary of that, and let's say I'm only 50 years old, then I would be taking it based on my life expectancy. Nonetheless, that is the at least as rapidly, right? I'm taking it out over the life expectancy of the beneficiary of the plan at the time. And so that was a big, big change in the rules and a misunderstanding. Some people think that they over interpreted that. From looking at the laws and regulations, I think they're absolutely correct. Was that the intention of Congress? I don't know. Will there be further regulation around that? I don't know. I've asked some people how they're addressing that, and they go, well, we're hoping that they're going to change the law. I'm like, well, that's not really a plan of attack. No, they have made an exception for 2021 and 2022. Remember, in 2020, they didn't require any distributions. So in 2021, 2022, that kind of surprised me that they've given us a break for 2022. I think the amount of commentary they've gotten about this has told them they need to better clarify what's going on. And of course, that guidance is not going to come out till the end of the year or early next year, according to their estimates. And so it'd be pretty hard to make us or penalize us on what's happened so far. The concern that a lot of people had was that, holy cow, you've changed the way that that's interpreted. And I didn't take a distribution last year because I thought you could wait 10 years. What the IRS said was, we will accept for 2021, this was their original statement, we will accept for 2021 any reasonable interpretation of the law. Well, in their own publication, in multiple different places, at least 3 different places, they said that you could wait 10 years before you take the money out. So it seems to me it'd be pretty easy to show up in court and go, if the IRS's publications are not a reasonable interpretation of the law, then I don't know what is as an individual. How could I possibly perform at a higher test? So that really doesn't concern me at all. And I do think it was very interesting that recently they said that they would waive it for 2022 as well. I think it's clear enough to the IRS that the new regulations and this new interpretation of the regulations is confusing enough to people, in particular when you deal with trusts. For individuals, I don't think it's difficult, and I don't think that their interpretation is necessarily wrong. When you look at the law, that's pretty much what the law says. It was an alteration because the 5 years before was wait 5 years and then take it out. And presumably this was just a doubling of that 5-year rule. So that's where the confusion falls in there. But that's the new default. What that did is it took away the stretch for most people, right? The stretch was that I could make a life expectancy distribution before. Well, now life expectancy distributions are only allowed for what they call eligible designated beneficiaries. Any old beneficiary with a heartbeat, basically, is a designated beneficiary, and that's when the 10-year rule applies. If you're a non-designated beneficiary, then basically we still have the old rule, which was the 5-year rule instead of the doubling to the 10 years. I think they felt an obligation to stretch that out to 10 years because if they're taking you off of life, they're forcing everything out in 5 years. Again, take your $1 million example, that'd be $200,000 a year in addition to whatever other income that I have, substantially has the potential to push you into upper tax brackets. And so I think that's why they did the doubling of the time frame. So eligible designated beneficiaries are basically 5 categories: your spouse, a disabled person, a chronically ill person, a person within 10 years of the age of the decedent, because that doesn't substantially stretch out the time period, or a minor beneficiary. And minors are minors up to age 21. They've clarified that in the law. Another clarification we got in those regulations. So that's important. And there's a comment, so I just want to swing back in here. I've seen whether they formalize the RMD rules next year, whether beneficiaries will need to make up for missed RMDs. My understanding is they have now officially said that no, you do not have to make up for previous years. That was the comment that I made about initially, they said any reasonable interpretation will do for last year. And since the IRS's interpretation in publication 590B was that you didn't have to take anything out for 10 years, it seems to me that's a reasonable interpretation. Now, they've more recently come out and stated that they will not penalize for 2021 and 2022. So that tells me that there's more on the way, and we'll probably be talking about this again, perhaps in our sessions next year, if this is valuable information to you. Another question: how would distributions be calculated if someone inherited an IRA after the owner started taking RMDs and need to get the funds out within 10 years? So we will talk about that. Distributions calculated if someone inherited an IRA after the owner started taking RMD. So you'd use the beneficiary's life expectancy for the first 9 years and take everything out by the 10th year is the basic short answer to that. Is it just they need to take some money out on an annual basis and make sure it's all distributed by the end of the 10th year? That's correct. So before age 72, participant owner dies before age 72, they're not in their RMD phase, and I'm named as beneficiary of that plan, I can wait 10 years, take everything out in the 10th year. Again, slowest. I'm not recommending that. I'm just saying that's the slowest that you can take it out. But if the person's over age 72, that's when this at least as rapidly rule kicks in and says, no, you have to take out the money at least as rapidly as it was before. So if dad was taking life expectancy distributions because he was over age 72, and now son has inherited that those funds, then son takes it out based on son's life expectancy for the first 9 years, and everything has to come out by the 10th year. Again, slowest that it can come out. So I think that was the meaning in your question, and what needed to be addressed there. Let me know if that's different. What about Roth IRAs where there's no RMDs in the original owner, but they die after age 72? They don't have required minimum distributions from Roths. There is a lot of talk in Roths, them having to come out at the same speed as other things because they're trying to push the money back out into circulation. So even though there isn't a tax element to that, that's why it kind of surprised, I think, a lot of us. I think they just want the money to be back out in circulation, not just sitting in an investment account somewhere, but in the hands of a consumer where they can use that to bolster the economy. I assume that's the thinking behind pushing Roth money out of the accounts. All right, so back into the stretch. So stretch is only available to those 5 categories. A spouse generally won't do the stretch because they're going to do the spousal rollover in most cases. Maybe they would do a stretch if the surviving spouse was substantially older than the deceased spouse because they could use the deceased spouse's life expectancy. So if the young spouse dies and the old spouse survives, that's the only time I can think of where it'd make sense to do that. Otherwise, you're going to do the spousal rollover where the spouse can simply roll it over and treat it as their own. Only available to spouses, of course, to do that. So the stretch rules now apply to disabled, chronically ill, pretty straightforward definitions and regulations about that. Somebody within 10 years of the decedent, again, they're just going to use their life expectancy for the payout portions, or a minor beneficiary. So a minor can stretch it over their own life expectancy up until they become an adult, which would be age 21. They finally clarified that. We didn't know if it was 18 or 21. The new regulations clarify that that's age 21. So age 21 plus 10 years basically is the new age 31 rule. So a minor has to take out all the money by the time they're 31, but at least as rapidly. So if the decedent was over age 72, you'd have to start taking it out at the life expectancy of the minor until the age of 31, and everything would have to come out by the age of 31. Again, it can always come out faster. Just talking about the slowest money can come out of the plan. Okay, so you have to make the stretch election by September 30th of the year after death, and make the first distribution by December 31st of the year which the first anniversary of death occurs, right, by the following year, and that starts your life expectancy period. For minors, it's the age of majority, which is 21 under the new regs, and then the 10-year rule after that. All right, so there's your basic rules for this area. We're now going to add trusts into that, and that'll become a little bit more complicated, and where I think it becomes, some of their definitions are not sufficient, in my opinion. Estate planning for the retirement plan has always come down to basically 2 questions. I always just ask people, who are you leaving the money to, right? Who's your beneficiary or beneficiaries of the plan? And do you want it, I didn't find it was sufficient enough, but it's an easy thing to remember, right? Do you want it to go to them outright? Or would you like to have some control over how that money is used? Remember, this was the initial driving force behind why trusts were very often used and trusts got integrated into the stretch conversation, is that people were concerned that if the money all goes out to my kid, they're not going to make the best decisions with the money. It's surprising to me how many people are concerned about that and do not want the kids to have all of that money at once. And so trust became a very common place to push these assets and continue to be exactly that. So in a very simplistic context, I can leave it to if they say my spouse, okay, great. Do you want to go outright to them, or do you want to go to them with some control? In other words, look at their estate plan. If they're using a Q-tip trust, for instance, is that a control issue, or is it just a postmortem planning tool? Q-tips can be used for lots of different things. It doesn't mean that there is an unusual family situation, but there are certainly, remember the Brady Bunch, right? You had a man with 3 sons married to a woman with 3 daughters, right? So the first public reference to having split planning, blended family situations, more complicated family dynamics that come up in this, and wanting to be able to control where my assets go. So certainly he loves his spouse, and we wanted to make sure that she's taken care of for the rest of her life if he died first, but then to be able to control where those assets eventually go. That was the essence of the Q-tip trust, and why the Q-tip trust was put into the code in 1981 when we went to the unlimited marital deduction. And so that certainly applies when this is the single largest asset the average American has when they retire, when they pass away. That's a really, really important thing to consider, where those assets are going to go. So even in spousal arrangements, sometimes the outright distribution and the rollover to the spouse isn't always the right choice. It's the most flexible choice. It has the most tax options available to him, but you lose the control over where the assets are eventually going. And to some people, that's going to be of concern. Same issue with the kids. So I could leave money outright to my kids, but if people had any kind of use concerns associated with that, that's when they wanted to have the stretch. Well, now you can't use a stretch anymore. You have that 10-year payout period. And so we'll talk about some of the characteristics of when you're leaving it to a trust as defined in these regulations. Certainly charity, and to the extent the client is charitably inclined, this is generally the best place to leave your money is to charity. But again, if it's a major asset of mine, and I'm not leaving most of my assets to charity upon my death, it may not be with everything. So outright to charity is the finest alternative from a tax standpoint, because you get rid of the income taxes and the estate taxes on the assets if they have a large enough estate. But you could also have ongoing control in their charitable trusts or private foundations or donor advised funds, even 100% charitable arrangements, also charitable lead trusts or charitable remainder trusts, which I think are a super alternative, and we'll finish up with in our talk today. So because this could easily be an entire session by itself, going through these rules and the regulations in detail and all the language that goes along with them. Perhaps we'll do that in next year's sessions. I tried to put all the factors on one page once I understand what those factors are. Okay, so let's just start with, it's either an individual or trust as beneficiary. So I'm going to go down either this road or I'm going to go down this road. If it's an individual, right, we just need to know the definitions that individuals fall into. Are they an eligible designated beneficiary? I gave you the 5 characteristics of those. Or are they just a regular designated beneficiaries? They don't fit into one of those 5 categories, but it's a person, right, an identifiable individual who has a life expectancy, and therefore that can be used. Or is it a non-designated beneficiary? Estates, charities, which is silly because charities aren't going to want to delay taking distributions from the plan, or a trust that doesn't follow the new trust rules, the new definitions of trust. So a trust could also fall into that category of non-designated beneficiary. So eligible designated beneficiaries, again, generally speaking, we can use a life expectancy, designated beneficiary 10 years, non-designated beneficiary 5 years as the general rules. You see those down here, right, for the rules that we'll go to consider, because they, depending on who the beneficiary is, that starts getting kind of extensive. Okay, if instead of an individual, it is a trust, then we need to look at the type of trust that it is. So rule number 1 is it a see-through trust? So a see-through trust has, for requirements under the law, those have not changed, right? Basically, it has to be a valid trust. You have to have identifiable beneficiaries, right? They need to be able to see through the trust to who the beneficiaries are, because a trust never qualifies. It's only individuals who qualify. And so they want to be able to reach through the trust and sort of touch the individual on the other side. Oh, okay, this is the person. We'll pat them on the head. This is the person that we're talking about as the distributee of this IRA. Then the second question is, if it's a see-through trust, what type of see-through trust is it? Is it a conduit trust? So a conduit trust is a trust, and they used this terminology before, but they didn't define what it meant. And so it was misunderstood by a lot of people. So a conduit trust basically is a trust that says any distribution from the qualified retirement, from the IRA or qualified retirement plan will be distributed out to the beneficiary. Okay, automatic. Any distribution made to the trust from a retirement plan will be distributed out to the beneficiary. Okay, so the trust is just acting as a conduit. It's not keeping that money in there. Everything is paid out. If that's the case, we're only going to count level 1 beneficiaries. And again, they don't say levels, so people are making up terminology to go along with this stuff. If it's not a conduit trust, then it's what they deem to be an accumulation trust. An accumulation trust is one basically that would be a standard trust. Money comes into the trust, there's discretionary distributions from the trust. Okay, fine. In conduit trust, you only count level 1 beneficiaries. In an accumulation trust, you count level 1 and level 2 beneficiaries. Okay, so what do we mean by level 1 and level 2? The level 1 beneficiaries, and again, I'm not using the technical language of the code. It just takes too long for us to go through when we're talking about other issues in this webinar as well. But level 1 basically is the current beneficiaries, anybody who could receive currently from the trust. Okay, let's create a simple scenario. I have a marital trust. My spouse gets all of the income on an annual basis, and so much or all of the principal as my spouse needs for her accustomed manner of living. And when my spouse dies, then the money goes on to my issue per stirpes, right, to my kids. So if that's a conduit trust, and it says not only is all income distributed in discretionary distributions, any retirement distributions get paid directly out, then we only count the spouse. Okay, level 1 beneficiary. But if it says, if it's not a conduit trust, it has just standard marital deduction features. All income is paid, and so much or all of the principal is paid as the trustee deems appropriate. That would be deemed to be an accumulation trust. It doesn't have that conduit feature associated with it. And so in that case, we would look at both level 1 and level 2, not just the spouse, but also the kids or whoever the next beneficiaries are. When we're considering what the payout levels are. So in that case, basically, I would have an eligible designated beneficiary in the spouse, but also a regular designated beneficiary in the kids, assuming they don't meet any of the special EB rules. And therefore, that trust would be subject to the 10-year rule and not the pure life expectancy rules. Okay, so anytime we're looking at these trusts, you're looking back at these definitions and saying, well, what kind of beneficiaries does the trust have within the countable realms, right? We don't ever count level 3 in these regulations. We only look at level 1 and 2. And so level 1 is current beneficiaries. So let me give you another example that's not a marital trust, but still involve the spouse. Let's say that money goes into a trust and it says this trust is for benefit of my spouse and children or descendants, right? I might use a really broad class, and at the trustee's discretion. It's a big group of beneficiaries who are coming in. Assuming it's not a conduit trust, that'd be an accumulation trust, you'd count level 1 and level 2. This is where the regulations do not get really clear to me. If level 1 is everybody who could receive money now, then in that case, when I have a really broad definition, what happens if all the descendants are deceased, right? That would be the only level 2 that you could have. I personally think, this is just my opinion, I've not even heard some of the professionals in the area engage in this, that level 1 beneficiaries could also be level 2 beneficiaries. And I say that because in other areas of regulations, like the tier system that we use for income taxation does that. I can be a tier 1 beneficiary. It means I get required distributions from the trust for income tax purposes, and a level 2, which means I can get discretionary distributions also from the same trust in the same year. So I can be level 1 and level 2. So if I had a trust that, this is just my contention, if I had a trust that says pay all income to my spouse for life and so much or all of the principal to my spouse and or children, that certainly spouse and children are in level 1 because they're all potential current beneficiaries of that trust. But then when the spouse passes away, the trust distributes outright to the kids as long as they're a certain age. Then it seems to me the kids would be level 2. Kids are in level 1 and level 2 in my interpretation of that. They don't have examples that seem to bear that out, and so we'll continue to watch that and see how those regulations play out. To me, that's how it would make the most sense. Otherwise, you're pushing down so far, you're getting to the very kinds of remote beneficiaries that they were trying to avoid in the regulations. But that's an area that is still cloudy. I'm willing to talk about it because you and I have to deal with this stuff on a day-to-day basis, and we need to have opinions about how that stuff is done and know what kinds of questions to ask as those things come through. So the potential payout methodologies, of course, we talked about before, the spousal rollover, only available to the spouse, that they can actually become the participant in the plan, and then distributions are made at their request. They can reset the beneficiaries, reset all the rules, basically. You can use life expectancies if the person is an eligible designated beneficiary of that. The modification for minors is that the life expectancy distribution only lasts till the age of 31, at which time all money would have to come out. In general, for all distributions, the at least as rapidly rule I talked about before would come in. So if death is later than the RMD, you have the at least as rapidly rule applied. If it's before the RMD, you don't have to apply the at least as rapidly rule. And that the general rule for designated beneficiaries is that everything has to come out within 10 years using the at least as rapidly rule. And the 5-year rule for non-designated beneficiaries would apply. Right. And again, that would be with a RMD, since a non-designated beneficiary doesn't have a life expectancy. You use what a lot of people are calling, again, I don't have a name for it, but the ghost life expectancy of the participant decedent. Whereas when you have a designated beneficiary, you have an individual who has a heartbeat, and so we can use their life expectancy to make that lifetime payout amount determination. All right, so this just goes in a little bit more detail and addresses each of those scenarios: outright to spouse, into a Q-tip trust, outright to a non-spouse, to a family trust, to a charitable trust, or into a charity directly, right? We talked about those in that summary page that we had right up front. But I want to touch on one other thing in the last couple of minutes that we have left, and that is the use of a charitable remainder trust as a stretch IRA alternative. Okay, let's just concentrate on the major class. Outside of spouse, your typical beneficiary is going to be a designated beneficiary, a child of the owner of the account. And the number of people who've told me they're really distressed at this taking away of the stretch IRA rules greatly concerns them. Well, understand, number one, you can use an accumulation trust. Yes, all the money will have to be paid out to the trust within 10 years. Yes, the trust will probably pay income taxes at a higher rate than your child would, right? Because trusts are taxed at a compressed tax rate. They get to the top tax rate faster. So many people are like, oh, no, the trust is going to be much more expensive. But when I talk about that to the clients, they go, well, that's okay. I'll pay more income taxes. I don't want that money to be all outright in the hands of my kids. So the accumulation trust is a way to go to do that. It's just going to be a little more expensive income tax wise. The other alternative is this. I take the IRA rollover, whatever account that it is. When I pass away, I leave it into a charitable remainder trust, right? We've done sessions on charitable remainder trust before, and we'll probably need to do some again, right? Just because this is going to be a real viable alternative, I think, for a lot of people. That means that I meet all the rules. Forget all the regulations and everything I just said. You pay out on day one, as soon as you can, 100% of the IRA account, outright distribution into a charitable remainder trust. That would make the entire thing taxable. But guess what? The trust is exempt from income taxes because the trust, as its name implies, charitable remainder trust, eventually goes to charity. So anything that happens inside the trust, there's no income tax consequence. The trust could then have lifetime payouts predefined in here to pay out a uni-trust amount, right? A recalculated percentage amount. The lowest number is 5%. Let's just use that because that's also within our sort of normal withdrawal rates, sustainable withdrawal rates amount. So let's say I say there's a 5% uni-trust going to my son for life. All of a sudden, you have this very similar lifetime payout should be a sustainable way of being able to keep that money flow going out to the beneficiary. Every year, you're going to recalculate the value of the trust and pay out 5% to the beneficiary. They can't ever dip into the principal. They don't get discretionary distributions from it. That would be different from an accumulation trust where you could dip into any or all of the account. If truly what you want to do is kind of annuitize the arrangement, you could simply set it up in a way that the child would get lifetime distributions from that. Whatever the balance is, once the child passes away or whoever the beneficiary is, then the money would simply go to charity. So this is a way to be able to, an alternative way other than the accumulation trust, to be able to create a lifetime payout that meets all of the rules and basically sidesteps all of the rules that are under these new regulations. So I know that was a lot of information to take in a relatively short period of time. Hopefully made that clear enough and usable enough in your day-to-day lives that you can go out and have these conversations with your clients and to continue to look at this area, right? Engage yourself with top estate planning attorneys and CPAs who are paying attention to these rules as well. I expect that we're going to hear more from the IRS. They have told us that we will by the end of the year or early next year. They're clearly hedging that because they didn't do too well this first go around in putting out the proposed regulations to these rules. And the word proposed, by the way, doesn't just mean they're out there. That means this is the way the IRS looks at it, and this is the way the IRS is going to be enforcing it. So they are really important. Don't think that the word proposed just means they're floating that idea out there. Last chat question. Can I clarify? What about for Roth IRA? So in this area, I would have to look back. I don't remember off the top of my head, and I don't want to say that incorrectly with regard to the Roth IRAs, but I believe that they are at death having Roth IRA accounts pay out also in accordance with these 10-year rules. Even though it's not a taxable issue, that took a lot of people by surprise because they're like, well, what's the deal? Why? We've already paid the tax on it. But I believe they want to get the money back out into circulation. We'll double check that, and if I can get an answer to you through the NATC, we can do that. Because I didn't see anybody else chime into that as well. But I believe that these apply whether it is a taxable or a Roth at death. Of course, we know during life that isn't required, but at death, Congress has definitely taken a bent towards getting distributions made out of the plans. All right, that brings us up to 2 o'clock, just over, answering those questions. I will continue to stay on and answer questions. If you got them, thanks so much for being here. Are you looking for an opportunity to earn a substantial monthly income while helping business owners obtain financing? Then Go Capital's broker referral program is for you. As a registered broker, you'll have access to a variety of business loan and real estate financing programs for clients nationwide. You'll also receive all the training, marketing, and sales supports you'll need to quickly start earning commissions. All this at no cost to you. Why is this such a great opportunity? With approximately 30 million active small businesses in the U.S. and banks limiting access to traditional commercial financing, loan brokers offering alternative funding are in very high demand. You can easily earn over $10,000 in monthly commissions by offering loans from $10,000 to $5 million. Go Capital services include revenue-based loans, equipment leasing, business lines of credit, unsecured term loans, commercial real estate mortgages, and more. With us, bad credit, tax issues, and high-risk industries are not a problem. Whether you're an accountant, banker, realtor, no business owners, or simply want to enter the lucrative field of alternative business lending, our broker referral program is designed for you to succeed. Join the Go Capital team and start earning today.
Hi, this is Bezel Bay, and today you'll be enjoying Wtdta Radio, where we'll be exploring the world of accounting, current expected credit loss provisions, estate planning, and tax planning, just to name a few. Don't forget, in the evening session, we'll be definitely going into civics and syntactical trust. So remember, if you listen long enough, you will definitely learn something. Peace and love, family. Peace and love.
We're here to serve you, so.
Are right, good morning, everybody. Mike Courtney here, Mass Mutual, Eastern PA, brokerage director, and I'm joined by my good friend and counterpart, Steve Parisi from IBC. Steve, how are you today?
Fantastic, Mike. How about yourself?
Good, real good. Sunny and going up to about 60 degrees here in southeastern Pennsylvania, so can't ask for much more than that mid-February.
Right on, man. Same thing here.
Must have been all the love in the air from Valentine's Day. So today we want to talk about PUA fees for Mass Mutual, PUA fees for the Guardian, and how they affect the policies, and some things that Steve and his team do to really break down those fees and show their clients what the policy effect is and what the internal rate of return is. So, Steve, I know you have some visuals you want to lay on us.
Yeah, we'll definitely use some visuals for this one. And when it comes to PUA fees, they, in my opinion, are one of the most complex and confusing topics when it comes to whole life insurance products. When you have someone interested in maximizing the cash value, because you'll see on an illustration, on your formal contract, a certain PUA fee that is assessed from the insurance company and the product that you selected. So you could see a fee that could be anywhere from, call it 5 to 10%, sometimes a little bit higher. And if you're a consumer making a PUA payment of 10 grand or whatever the dollar amount is, and you see a PUA fee of 10%, naturally, like, what goes through your mind?
$1,000 fee, $9,000 going into paid up additions.
Correct, that I would see in cash value. Unfortunately, it does not work like that. You will not see a full 10% deduction right off the top. It will be less than that in the first year. And then as time passes, you'll see the compounding, meaning guaranteed rate and dividends applied to your policy, and it will get better and better. So if someone's asking about, hey, explain this PUA fee rider or PUA rider fee to me, like, how does it work? What am I actually charged? I really want to understand it. We'll go very deep. I mean, we've got video content, we've got spreadsheets that complement illustrations that show the exact numbers. But at the same time, if someone says, just like, give me the bottom line, like, how do I know what the fees actually are? What I'm going to direct someone to is the net cash value or total cash value column on a life insurance illustration, which mean the exact same thing. Some companies use the terminology net, some use the term total cash value, but that's your money column. And when I'm trying to figure out, like, what's my net cash value, I just want to see how much I paid in, what my cash value is. If I like percentages, I'll say, here's the net return or the internal rate of return. And then if I like dollars, I'll say I lost this much money or I gained this much money this year. But that does help simplify things and kind of get someone who just wants the quick answer back on track to know, okay, like, that column's what I got to look at? Yes. All right, I'm good. Does that make sense?
Yeah, absolutely. I have found that when I'm talking to folks who are getting real wrapped up in understanding the fees and breaking down the fees, and I take that approach, that's oftentimes not satisfying for them. Which I've for me, it's like, that's all that really matters here. I'm paying $1 of premium, and what's the end result? I don't really care how we got there. I don't think,
Yeah. So I do know what you mean. And over time, like, I've come to appreciate that too, where I'll ask someone, do you want just the bottom line quick answer, or do you want really to understand how the fees work? When I'm talking
to understand the whole thing inside and out. Yeah.
Correct. Some do. And I know probably what happens on your end when you get an agent that says, okay, I really want to understand how this works. That's likely a situation, speaking from experience, where someone's asking them, and the agent's like, I don't know. This stuff is so complex. Like, I'm just trying to maximize the cash value. I'm getting all these left field questions. So they're going to go ask someone who works at the insurance company, you in this case, at Mass Mutual, hey, how does this work? And you're like, well, this typically works, this solution. They're like, no. I want to understand how the watch is built. Like, well, I sell the watch, I don't build it. Right? So there's a difference there. Yeah. But understanding
how it's so complex, like,
Yeah, why? That's the big question.
Well, we live in a world of like all this disclosure, and it just seems
doesn't have to be.
It seems like a strange thing to be so complex.
Yeah, it does. I mean, you can argue that with anything. Like you could argue, why does the insurance company state you've got a dividend rate of a certain percentage when my money doesn't grow by that much?
Right.
That confuses people to death, and I totally get it. But let's break down we can break down the PUA fees a bit, and I'll show you how we do that. Let's start off just with
before you get started, Steve,
Yeah.
Is there any situations where base premium, because of a PUA fee, base premium is going to allow for more cash accumulation than a paid up addition type premium?
That's a good question. And typically the answer is no, especially when you look at the guaranteed side of a life insurance illustration. The higher the PUA payment is, the higher the cash value will be.
Because there's no cost of insurance coming out of a PUA payment. It's just whatever the fee is, and the rest of it is going into paid up additions.
Correct. That's your charge. So a PUA payment, what it does with a whole life insurance policy is it purchases you a single premium whole life insurance policy. It's added to the existing policy. It receives its own dividend. It adds to the whole life death benefit. It's optional to pay each year, so it's not a recurring bill like what you receive with your base premium. So once you pay it, the fee is assessed. You get paid up life insurance from it, shows up in cash value, but then it receives the guaranteed rate, it receives dividends, and continues to appreciate over time. So that PUA rider is going to accelerate the cash value growth at the fastest pace when we look at actual policies. Does that make sense? Mm-hmm.
Yep.
Cool. So this is an illustration. This is from 2022, but that's right. So this is a whole life 100. And this is a lengthy illustration here, because we've got a lot of material. For example, when we're running an analysis like this, I've got to look at more than just the current dividend value. So we've got the guaranteed values, midpoint values, current values, a lot of info. So quick breakdown here before we get into the analysis is we've got a total of $1 million going in, and this is a whole life 100 product, which we don't use a whole lot, our company at least. We don't have to get into the reasons why, because we're going to look at the PUA fees. There's my first year cash value. There's the crossover point between years 6 and 7 with this product. But of that 100K, this guy, my question would be, where is that money going? Here's your base. Then you've got LISR, life insurance supplement rider, 10 grand. See this face amount, just about 1.5 million. That's a 1-year term insurance rider that's attached. So this is actually a combination, this 10 grand, that first satisfies the term rider, and the rest goes into PUAs. There is a PUA fee assessed to that. You'll see exactly what it is in the illustration as well. I'll get to that in a second. And then we've got AILR, additional life insurance rider, which is Mass Mutual's basic PUA rider, 80 grand there. So here's the money going in.
So before all of that 80 grand is subject to a PUA fee, some of the $9,999 is subject to a PUA fee.
Correct. So let me see if I got an outlay report here. I do. Let's just start with the current. I'm going to go through the guarantees as well, because you have to when assessing PUA fees. But of that $10,000 LISR payment you saw,
Yep.
So here's your LISR payment. Here's how much is going toward the cost of the term rider, and then the rest goes into PUAs.
Okay.
Yeah. And if you're not paying it, the dividend will cover that pretty easily. So let's look at the first year, because here's here's what I would argue if I'm a consumer. I'm paying in $100,000. My term charge there, let's call it $1,000, just for simplicity, before I really get into the nuts and bolts. Term rider cost was $1,000. Keep that in mind. The base premium with a whole life 100 product, 0 cash value in the first year. So of my $100K, none of that shows up in cash the first year. I know $1,000 of this lister payment is not showing up in cash value because it's satisfying the term cost. So I've got $9,000 left, $80,000 down here. So $89,000 total that is being deposited into PUAs. So a consumer hears PUAs accelerate the cash value growth, which they do. But if I pay in $89,000 and my net cash value is less than $84,000, what happens naturally? Where's the money going?
Right.
Yeah.
PUA fee.
Correct. So,
well, wait, why is there, if I have an all base premium, I don't have 0 cash value at the end of the year?
So with a whole life 100 product, you would actually.
Yeah.
So with a traditional product, so we can see here, actually, this column. So a good point you raised, because with some products, the base premium, most products will build cash value, like a 10 pay or 15 pay that we use.
Right.
Yeah. So here, first 2 years of the base premium component, goose egging cash value. So, yeah, so that's not showing up in cash value in the first 2 years. What's building the cash value is our PUA payments. And a nice piece here too, this column, cash value of additions and year. How I like to think of this in my own mind is money I'm adding to cash value of additions. This represents PUA payments and dividends applied to my policy over time. So money I add in PUAs and also dividends that are added. It excludes any buildup from base premium dollars, any cash value buildup from base premium dollars. You can actually see that in the first 2 years, because I got nothing in base premium that showed up in cash value. That cash value of additions column is equal to the net cash value column.
Got it.
Cool stuff, right?
Yeah, I mean, I've been with Mass Mutual for 11 years. That's the first time I've ever heard that description.
Got it.
Different columns. Thank you.
Got it. Yeah, no, definitely. So a couple things here. What we'll also look at are the guaranteed values. And you'll notice no dividends here. The term charge is also higher in this particular case. So we've got to account for that, the lister term charge. Right. So you can walk through it via.
Because on the guaranteed side of the ledger, they have to show the maximum allowable term charge.
You got it. And the maximum allowable PUA fee if the company reserves the right to increase it, which Mass does with their lister and ailer. So you can, right, if you're in the business or if you're a consumer with an illustration, you can identify everything that's needed on this illustration. The issue is that it's 49 pages long. We've got different columns with the guaranteed and non-guaranteed values. We've got to go up to the top to get ailer fees and such. Like, it's a lot. So one of the things we do here is lay it all out in this, which seems like a lot, but I promise it's not. I can just kind of walk through it. It's breaking down an illustration. And then the main purpose of this exercise is what's highlighted in yellow here. So if someone's asking me what is happening with my PUA rider, because I'm told with the Whole Life 100 product that the fees for ailer and lister, what you'll see on that illustration, are 10%. So there's that 10% fee. So base premium, ailer payment, $80,000. Lister payment, $10,000, but there's a term charge there. So of that lister payment, we've got to back out the term. There's the actual PUA payment, $9,030. So what I want to do then is when we assess the 10% charge, make sure it goes on the PUA portion, not the term charge portion.
Right.
So here's what I would look at then, is if I'm looking at the total charges and fees, here's my total PUA payment minus the term cost, just about $89,000. 10% of that is what? $8,900.
Right.
So if you take 89,000 minus 8,900, what would you have in cash value? Close to 80 grand. Yet, from the illustration, there's our cash value. So it's not like we didn't actually lose 10% there. What we lost from that PUA payment was $5,370. So what happened is the company assesses their charges, but when I'm making payments, I also have a guaranteed rate that's applied to the policy. So in short, after they deduct their charges, after they apply any interest that they're crediting to the policy, what I want to know is, okay, I paid an 89, I lost 53.70 in the first year, which means the net internal rate of return on that PUA payment was just about negative 6%. A lot of info there. Any questions on that?
Yeah, no, I mean, I follow it, but it looks like here's your PUA fee of 10%, but we charge you less.
Correct. That's the confusing part right there.
Right.
Yeah. Wish it wasn't like that. And that's the case. Huh?
What is that?
Like, why is it like that?
Yeah.
So that I don't know.
Oh, jeez.
Yeah, that I don't have an answer for as far as why it's less than what they actually disclose. You'll see that with all companies. I can show you a couple of examples here too. But like as we look at this,
is it because you're earning dividends on?
So you are earning dividends, but at the same time, dividends are not paid in the first year.
Right.
Right.
Right. This
Yeah.
spreadsheet is very detailed, and I understand what's going on, but it's like I understand what's going on, but there's not really a kind of straight math solution here.
Well, correct. And I've got to walk you through it too.
Right.
Yeah.
If I was a different kind of guy, I think that would drive me nuts.
So it can drive you nuts, and it can drive a lot of people nuts. So to answer your question, like how we'll walk people through this, as far as the fees and such, like it's a lesser number than what it actually is, but it still is what it is. Like going back to the net cash value, I know that's what I actually have in value. So what I want to do is just understand exactly when I'm adding money to the policy, what shows up in cash value and what does not. And have awareness that when I make PUA payments, especially in the early years, I'm going to notice not everything shows up in cash value. It's not.
Right.
However, as time passes, like if I look at this in year 2, I made a total PUA payment of $88,000 and change that accounts for the lister term charge. And of that $88,788, I did not get all of it back.
Mm-hmm.
I lost about $670, which comes out to an IRR negative 0.39%, even though the disclosed charges were 10%. It's starting to grow a little bit now. That's why.
Yeah. Yeah.
But again, this
you're overcoming the charges with the growth.
Correct. And again, this is isolating just the PUA cash value, because as it grows, we cannot include the base premium growth in that too.
Right.
Yeah. Open.
Okay.
Fun stuff, right?
So the answer for the client is like, here's the company can charge in this scenario up to 10% of a PUA fee, but based on the illustration and the projections, here's your actual internal rate of return on those payments.
Correct. And this is their 10% charge. So what happens, right? Going back
including that's going to include your ongoing growth.
Right. And if you want to look at a worst case scenario, so what we did here was just go to the next tab. And this goes back to that guaranteed illustration we looked at with the guaranteed values. So no dividends, but also what you have working against you now. It's this. You've got the same Ailer charge.
Max lesser charge.
Correct. They reserve the right to increase that. They also can increase the term cost. So now I can see, all right, what's my net numbers going in? And then what's the actual PUA growth here? If I want dollars, paid in 89, I got 65. I lost 6,500 of that 89 in the first year. Then I lost 4,100. Then about 1,500. Now I start to see a positive result. And that's every single time I make the payment, those charges are being deducted. And this assumes a guaranteed rate at 375.
Mm-hmm.
So again,
how does that compare to the total overall cash value IRR?
Mm-hmm. So good question. Here we go.
That's going to be less, right? Always.
So the overall cash value. Yeah. As time passes, so I mean, we stopped the funding.
Oh, my screen's covering that. Okay.
I got 10 million columns here. That could be it too.
Yeah.
So initially, while you are funding it, you do see that PUA IRR is a bit higher. But what I've got to do is continue this on, actually.
It catches up?
Yeah, I mean, here's your annual.
I wouldn't think it would, though.
Mm-hmm.
Well.
No, you mean the overall IRR catches up.
Yeah.
See if I got it programmed in here. I do. No, are they equal? Well, they're equal, actually. Beginning year 16. Before that, they're not. So year 16 in this example, we hit that kill switch, reduced paid up.
Right.
Got rid of the base premium, put everything on a level playing field as far as the cash value growing together, meaning base cash value, PUA cash value, everything's just going to grow together now.
Oh, that's not cumulative IRR. That's each year's.
Correct. That's the annualized IRR.
All right, that makes sense then.
Yeah, the cumulative's on the far right, and that's only for total cash value. I don't have that for the PUA. So, yeah, I mean, this is deep stuff, and it's easy to get confused when I'm really trying to understand it. So, what we do have as a solution here, we've got videos where it's just me walking through this line by line, going back to the illustration, and assessing how the PUA fee actually works. Meaning, if you're going to make these payments, you're going to see in the early years, not all of your money shows up in cash value because of the PUA fees. It can be concerning to you, Mr. Client or Mrs. Client, when you see these PUA fees very high. However, here's what you'll actually see. Here's the guarantees. Here's based on the non-guarantees. Here is a different product here. If we look at their 10-pay product, much more attractive.
Right.
So here's what we'll actually see. This is what we like to look at to see the net numbers and then really look at the net cash value.
Right.
And that typically puts one in a state of mind where they say, okay, that makes more sense. I get it now. Typically, when we've provided an overview, like with these PUA analysis videos and spreadsheets we have, we've always had a satisfactory outcome where they say, okay, that makes sense. I get it. And it's typically engineers or individuals that are very analytical and want to know how it works, which I get, put this together because I wanted to know how it worked. And then two, I would get questions about it, and it would turn into 45 to 60-minute conversations trying to help someone understand how it worked. And it was just eating up so much time. That's for me, let alone new agents, that work with us.
I guess it's a lot easier for that type of client to, after going through that exercise with you, realizing that you have dug through all of this detail explain the detail in, excruciating fashion, then I guess it is a lot easier for that type of person to say, you know what, it probably makes the most sense to just look at my net cash value versus total premiums paid and look at my internal rate of return.
Yeah. I mean, that's often what happens. Like, we've never had an issue after we go through the deep dive, because everything adds up. Like, this is something where if you look at this and you just kind of go, whoa, or think, my goodness, that's overwhelming. I get it. Like, I've been there a lot of times. And then what I'm able to overcome that is just start line by line. And we've got a video presentations on the different products, different carriers. We got this for Guardian, guaranteed and non-guaranteed values. So we can walk through it. They're like 10 to 15 minutes a piece, where people can see, here's exactly how it works. So depending on the product one is interested in, if they have questions on that PUA fee, that's when we provide that content so they can see how it actually works. And that's often what solves the problem there.
Right.
Yeah.
How you really use those, you and your team really use those videos for a lot of client training and explanation, and
big time. Yeah.
It's a huge time saver. I mean, it was a huge, I'm sure it was not a huge time saver building that video library, but
no,
paying off now.
Yeah.
What about the Guardian? Is there anything drastically different or unique about Guardian? How they,
little bit easier, just because their PUA fees, like Mass Mutual, we looked at their Whole Life 100. They've got their PUA fees at 10% AILR and LISR. They've got two different PUA riders there. But then with LISR, that can be increased to 12%. But then if you look at their 10 and 15 pay products, they're a bit lower. So there's there's more PUA fees you have to be aware of with Mass.
Right.
Whereas with Guardian, you've got a 10% PUA fee. Except for their L95, they offer a 5% PUA fee for that as well. And that's across the board. If we're looking at the guarantees, there's no increase in PUA fees or anything like that. So it does make it a little bit easier for the agent to explain it, right? Not so much for the consumer, because we still have a lot of information. But we'll do the same thing. First, we'll go through the illustration, like what we had. And then here's their L95 product. Or first, we want to isolate the base premium cash value, and the base premium death benefit. And we've got the term rider attached. So in this particular case, we've got money going toward base and PUAs, but we've got to back out the term rider. So we paid in $90K. On the illustration, you'll see $90,000 toward paid up additions.
Right.
But back out that $1087. That's why the net PUA payment is $88,913. Let me do this.
It's really kind of same as the exercise we're going through with Mass, just different percentages, but same kind of concept as far as you've got a base premium, you've got a rider premium that has some term component to it that isn't going to be subject to the PUA fee, and also isn't going to result in any paid up additions. So really trying to get to like what that net PUA payment is to figure out what the charge is.
Correct. And I forgot to update that term to 5%.
And when you were talking about the difference with Mass and Guardian, so Mass, when they changed their product portfolio as a result of Section 7702, the result was a bunch of the products had different guaranteed crediting rates.
Right.
They had different policy loan rates. They had different PUA fees that they could possibly charge. Whereas, so it results in you having to do all this different analysis depending on what the product is. But with the Guardian, it's they chose, everything was kind of the same for all their products except for this L95.
Correct. Yeah. And then the guaranteed rates are different with some products. I mean, the nice thing was, like, when the update occurred, is we had all of this complete based on the products, the 4% guaranteed rate. So what we had to do was just update the illustrations, look at the guaranteed and non-guaranteed values, change the fees. But for the most part, like all of the work that went into the initial build was complete, and you just got to make some adjustments.
Have you seen any other carriers or any other different products? I know that you don't, your group doesn't sell any IUL, but have you seen anything else out there in competition that looked like this, that was a turn on or something that was exciting? Or
yeah, so I know New York Life actually had reduced their PUA fees, which was nice to see. But it's always interesting with them. I haven't done the same deep dive in their product. What was interesting is I saw lower PUA fees, but that wasn't translating to stronger upfront cash value relative to the same case that we would see with another company and product. So that's something I've got to dig into more. But I did see them, it was a surprise, they actually reduced their PUA fee from what it was to 5%. So that was a little bit of a surprise. But aside from, on the whole life side.
And if that's not resulting in.
Right. Then it doesn't matter. Fun stuff, right? Yeah.
What about anybody else? Any other outliers out there that?
Not really. I did see a couple increases similar to Mass. Like Penn did increase their initial PUA fee, so a little bit bigger hit up front on the cash value, but at the same time, like they really tout their long-term illustrative performance. So I mean that looked better as the result of a higher PUA fee. But not a whole lot aside from that, just looking at things, because I mean PUA fees, that might hurt your upfront cash value a bit if they're increased, but really when you look at it, I do want to see the net cash value more than anything else. Like what's the big impact?
Yeah, definitely. I think though this process of going through answering the question in this way, I mean, anybody out there who's listening, if you're an advisor and you're accustomed to working with very detail-oriented clients, oftentimes there could be a very simple explanation for something, or, it is most effective and most, time effective to just look at the cash value. The internal rate of return on the cash value is the gist of the whole thing here. But they want to hear that you understand how this works, and they want to see how it works.
Yeah.
And then we'll see all the detail that goes into that. And then that I feel like that type of client then is a lot more comfortable saying like, okay, let's just look at the total cash value. And that makes sense.
Oh, yeah, that's always going to be the case. And I mean, how I look at it too, when these complex questions come up, a lot of times an agent will think like, what's the purpose of all of this? Like it doesn't change the net cash value at the end of the day. But if you feel like that as an agent, my advice would be to push that out of your mind and just tell yourself it's the client's money. Like they want to understand how it works. People are used to getting nickel and dimed with fees and everything in their life. It's extremely frustrating. They don't want to be blindsided by some surprise fee that they thought worked one way and then it didn't. And
it could be 5 years from now.
Correct. And the last thing they want to hear would be the last thing that you want to hear. Like, this part's irrelevant. Don't worry about it. Like everybody's heard that in their life, only to find out after the fact that, hey, I should have done more research here. And then you've got that sick feeling in your gut and your chest.
Yeah.
So it's like, when you feel like that, just remember that the person, it's their money and they want to understand it. So either take a deep breath, put the time in and do it, or refer it out. Like don't fight with a client. That just makes the whole experience sour.
Those examples that you showed, is there any potential for fluctuation there?
So with Mass, yes, or with any company where they do reserve the right to increase PUA fees, yes. Where you could also see fluctuation if the PUA fee is level, like Guardian, even based on the guarantees, is the 1-year term rider. If I've got that attached, they do reserve the right to increase that, so that can impact the net cash value. So there are things that can impact the overall performance. But again, those typically don't adjust that much, especially the 1-year term cost.
And they'll be kept. Well, the PUA fee increase would have a cap, right?
It does. Yeah, it does. Yeah. So if you look at Mass, like we talked about their Whole Life 100 product, you've got a current 10% AILR enlister fee. The cap is 10% on AILR into and then 12 on Lister.
Right.
And then with their cash accumulation products, like their 10 pay and 15, you've got Ailer at 7.5, Lister at 8, with a maximum charge of 10% for both of those.
For both.
Yeah. More geared toward cash value. Yeah. Fun stuff.
Yeah, it is. Well, listen, if anybody wants to take a deeper dive or wants to ask some follow-up questions here, feel free to reach out to either Steve Parisi or myself, Mike Courtney, at any time. I will tell you that from working with Steve for as long as I have, I can vouch for just the video library of content and his process for how he answers client questions, step by step, taking his time and going through, making sure the client really understands what they need to understand and what they, not even what they need to understand, what they want to understand from their perspective. So Steve, thanks a lot for all the info and detail today. And everybody else, have a great week and all the best. Thanks, Steve.
Thanks so much, Mike. Enjoy.
See you guys.
Okay. Bye.
Hi, this is Bezel Bay, and today you'll be enjoying Wtdta Radio, where we'll be exploring the world of accounting, current expected credit loss provisions, estate planning, and tax planning, just to name a few. Don't forget, in the evening session, we'll be definitely going into civics and syntactical trust. So remember, if you listen long enough, you will definitely learn something. Peace and love, family. Peace and love.
Are you looking for an opportunity to earn a substantial monthly income while helping business owners obtain financing? Then Go Capital's Broker Referral Program is for you. As a registered broker, you'll have access to a variety of business loan and real estate financing programs for clients nationwide. You'll also receive all the training, marketing, and sales supports you'll need to quickly start earning commissions. All this at no cost to you. Why is this such a great opportunity? With approximately 30 million active small businesses in the U.S. and banks limiting access to traditional commercial financing, loan brokers offering alternative funding are in very high demand. You can easily earn over $10,000 in monthly commissions by offering loans from $10,000 to $5 million. Go Capital services include revenue-based loans, equipment leasing, business lines of credit, unsecured term loans, commercial real estate mortgages, and more. With us, bad credit, tax issues, and high-risk industries are not a problem. Whether you're an accountant, banker, realtor, no business owners, or simply want to enter the lucrative field of alternative business lending, our broker referral program is designed for you to succeed. Join the Go Capital team and start earning today.